Every day, new traders wipe out their accounts trying to catch a falling knife. They try to guess the exact moment a market trend is going to snap downwards and turn around, and they get crushed. We are going to solve that problem. We are taking one of the most widely known chart patterns in trading and applying a specific mechanical tweak to turn it into a highly profitable setup. You don't need complicated indicators to execute this. As long as you have standard charting software and a basic understanding of how to identify a price trend, you can use this strategy. By setting strict rules, we remove emotion entirely. We are replacing subjective guesswork with a defined, repeatable mathematical edge. This graph shows a sustained upward trend flattening out. Normally, a double top forms with a second peak at the exact same price level. But here is the critical twist. The second peak drops noticeably lower than the first. This lower peak happens because the sellers who entered at the first top are overpowering the buyers. They're strong enough to step in and force the price down before it can even retest the previous high. That specific failure to reach the old high proves the buyers have lost control. It confirms a definitive shift in market momentum from a bullish trend to a bearish one. By waiting to see this specific lower peak anomaly, you filter out market noise and false signals, isolating a genuine high-probability trade opportunity. On our tweaked chart, focus on the central valley between our peaks. We draw a flat, horizontal line directly through this point to create the neckline. You enter a sell trade when the price physically breaks below this line. Do not make the mistake of entering early. If you try to anticipate the move before the neckline actually breaks, the pattern is invalid. To strictly cap your potential losses, you place your stop-loss order right on the opposite side of that neckline. Setting these strict physical boundaries directly on your chart transforms subjective chart reading into an objective, pass-or-fail execution plan. We use a vertical bracket to capture the exact distance between our highest peak and the neckline. To calculate our profit target, we project that exact measurement straight down from our breakout point to establish a hard take-profit level. Apply these exact mechanics to the inverse scenario, a tweaked double bottom. The required twist is a slightly higher second valley. The rules flip: break the neckline to buy, set stop loss below, and project the exact height upwards for profit. Mastering both the top and bottom variations gives you a universal framework. You are now equipped to capture major market reversals, regardless of the overall direction of the market. Let's review the complete workflow. We combine clear trend analysis, verify the momentum shift with our higher or lower twist, and lock in our risk and reward using strict measurement projections. The rules are absolute. Without that lower top or higher bottom anomaly, no trade should be taken. Your next step is to put this into practice. Open your charting platform, load a historical price feed, and successfully backtest this specific pattern at least 10 times before risking your capital. Long-term profitability does not come from accurately predicting the future. It comes from flawlessly executing a proven mathematical edge every single time it appears.